You and your friend are both moderately bearish on Nifty. You bought a bear put spread, the responsible, hedged, risk-defined structure. He just bought a put. Nifty dropped exactly as you both expected, but he made 3 times the amount of profit. You didn't get the direction wrong, yet you got paid less for being right, and the reason has nothing to do with your strike choices. Take a typical bear put spread, for example. You'd be long the at the money put and short the out of the money put. The spread's overall Vega would be positive because the long put's Vega dominates when we establish the position. Everything's fine so far, right? Now say the spot starts drifting towards the short strike. As it reaches there, the short options Vega starts dominating because the long put is deep in the money, so its premium isn't affected as much by volatility anymore. To see where the problem comes in, we have to consider how the implied volatility of options typically reacts to up moves and down moves. Institutions hedge their cash equity using index derivatives, and retail and HNIs do the same for downside protection. That means downside moves create an aggressive demand for long puts from these participants in a way that an upside move simply does not induce for calls. An increased one-sided buying demand would mean that the sellers would have to raise the prices of these options to discourage buyers in order to keep their inventory balanced, which manifests as higher implied volatility. So the implied volatility of these puts raises exactly when our bear put spread switches to short Vega from long Vega. So it actively drags down the profits that we gain from the long put just when we're expecting a nice payout from it. You could try to defend the bear put spread saying that you only expect the price to reach the short strike by the expiry, not prior to that. Hence it shouldn't be a problem. However, historically, market movements to the upside are typically more steep and sudden compared to up moves, which are more commonly slow and grinding. I've made a video on this topic too. I'll link it at the end of this video. Now, if we mirror this on a bull call spread, the problem entirely disappears. As the spot moves towards the short call strike, the IV starts falling as there is less demand for crash protection, and that cooperates with the same flip from long Vega to short Vega that we saw before. Hence, it's almost always a superior option to use long puts or a long volatility analog like a put ratio back spread to express a bearish opinion so that we end up on the right side of the implied volatility jump. And unless we're expecting a significantly sharp up move, vertical spreads tend to perform better to the upside because of how the short options IV falling pulls our profits upward. Where the bear put spread works out better is in lottery ticket structures, where you have both the legs far out of the money. This would give you very little capital exposure compared to a long option and a high multiplier risk reward. And here the impact of implied volatility is much less than that of the market move itself. If you only trade options with very little time to expiry, say daily or weekly expiries, vertical spreads can be a good pick because the payoff of the spread isn't affected by changes in the implied volatility as much as a further out one is, because there is a much smaller time window for moves in the underlying to occur. You'd also be less impacted by the effects of theta decay. So yeah, the question to ask yourself before entering a bear put spread isn't will the price reach my strike, but rather do I want to be short Vega exactly when IV is rising. Check out this video of mine to see how sellers raising prices and implied volatility go hand in hand, and this one to see that down moves are faster and steeper than up moves tend to be.